Welcome everybody to the Crypto Mondays community call for the week of April 9th or the day of April 9th. We have with us today our featured guests, Keli, Callaghan and Colton Connley. And we are going to jump right into a presentation today since we don't have much business. Keli, would you like to take over? Okay.
Yeah, sure thing. Thanks, Alan. Appreciate being asked back here. I know last time it was just me, and today I've brought Colton with me, mostly to jam as many K's and C's as I could into one guest lineup with Keli Callaghan and Colton Connley. For those that weren't here the last time I joined 6 months ago or so, I've been in crypto for 7 years or so now. I was previously the CMO at Algorand. I have spent my whole life in comms and go-to-market and big brand growth strategies. Algorand was a great time. I was there for 4.5 years, and I've known Michael Arrington for a long time as he was on the cap table there, and I was always very supportive and founder-first focused. Arrington Capital is a hedge fund with both a liquid trading business as well as a venture arm. We've made over 300 private venture investments over the past several years. Colton and I do a lot with supporting our founders, looking at new investments, what trends are going on. I thought it would be good to, one, just introduce Colton and have him share a little bit more because he does a lot of work on the ground with what's going on and with different founders and challenges that they're facing. And then I thought, again, I know that this group is very casual and very open, so we're happy to keep this aligned with that and keep it open for questions at any time. Just unmute and feel free to jump in and dive in. Does that work, Alan?
That works just fine. I mean,
great. So Colton, why don't I have you give a little bit of a lengthy, these folks know me, why don't I have you give a little bit of a lengthier background on yourself and what brought you into crypto? And then you and I can have a quick conversation on trends, what we're investing in, what we're seeing, challenges that founders facing, et cetera.
Sounds good. It's nice to meet everybody. I'm Colton. I joined Arrington Capital over 1.5 years ago now. It's coming up on 2 years. I'm an investment principal on the venture side of the business. I take a look at all of our new deals. I do a lot of our technical diligence, and I work with Keli very closely on supporting our founders as well. I got into crypto originally back in 2016, just as a retail investor. I bought ETH, and I noticed that a lot of times there were different prices on various centralized exchanges back then. And so I built some bots to arbitrage those out. I did that for a few years. And then I got really into DeFi. By the time I had gotten into DeFi, that was near the end of my time in college and beginning of work. I studied stats and data science and econ in college. So both the economics perspective and the computer science, machine learning angle. And then I went to Citadel right after college. After that, I was basically doing DeFi all of my free time, and I wanted to start something. So I left to start a DeFi protocol. We built a protocol that did cross-chain borrowing and lending. We scaled that up to 8 figures of TVL. And I joined Arrington 1 year ago when there was an opportunity for a new venture principal on the team. They were one of my investors while I was still a founder and a builder, and by far the most supportive investor that I had on my cap table. I'm not biased. I have a lot of other really great investors as well, but Keli is exceptional, and I really enjoyed working with her. I loved working with Mike, and so I had to join the team. And it's been a really great past couple of years. I've definitely enjoyed getting to expand my horizons beyond just DeFi, which is kind of where I started out, and get to put into use some of the things that I had learned doing stats, data science, and machine learning back in college. So that's quick intro on my end and where my background is and where I'm coming from.
Awesome. Thank you, Colton. And I think if you get internet back in here, I think it'd be good for having you chime in because I know you're on the ground in Paris. I'm not sure anyone else is. I think coming out of ETH Denver and then DOS. I don't know who attended both of those. I know me personally, Denver was interesting. It was just as we were coming off of the election bump and everyone was very, even keeled. There was a few things going on. There was interesting stuff. It was a little bit of a stark, the attitude at East Denver was a little bit stark contrast to Dawson, New York, because I think Dawson, New York was very much a different group of people. There was overlap, don't get me wrong, but it was a different group of people that are looking more broadly and more in terms of years or quarters and not necessarily months or weeks. So I thought that was really interesting. I'm not sure what the mood is in Paris this week. But I think, Colton, I think it'd be good for you to talk a little bit more because you're far more degen and technical than I. If you look at DeFi as it was years ago when you were getting into it and where it is now, what do you think the main changes are? And then where's it going?
Sure. I think that the main changes, in my opinion, are largely a result of the different macro environment that we find ourselves in now. The thing that made DeFi really rip back in 2020 and then 2021 was sort of the zero interest rate phenomenon and the free money era. And so the way that a lot of DeFi protocols were built, they were all built around incentives. And the idea was that if you did liquidity mining and you were able to attract as much capital as you could very early on by giving away your token and incentivizing more and more TVL and transactions, that you'd build a moat by being sort of the biggest in the arena. And I think for a lot of protocols, that actually turned out to be wrong, and that all of the capital they attracted was mercenary capital. And so you see in a lot of the TVL charts and the price charts and charts of on-chain activity, a big spike, and then everything sort of popped once the money wasn't free anymore, and there were some other large issues and blowups that happened in crypto. And so I think the focus now on DeFi is more of how can we make money off of structural market factors that are going to be sustainable, and how can we make money with real world assets from more sustainable yield sources. And so I think you're not seeing the same kind of explosive growth that you did in 2020 and 2021, but the growth that you are seeing is more real. And so whereas DeFi back in the original DeFi summer days was a lot of like lending primitives and DEX primitives that basically just got copy and pasted over and over again, I think the kind of things that you're seeing now are actually much more useful and innovative. In particular, you're seeing a much larger emphasis on perpetuals and perpetual exchanges, larger emphasis on capital efficiency because dollars are more expensive and harder to come by. And then you're also seeing a lot of attention on stable coins, and then how can we pass yield through to those stable coins? And so a lot of people have kind of coalesced around the basis trade in order to make that happen. And so I think as a general rule, DeFi now more focus on sustainability and real sources of yield, less reliance on incentives, and even to some extent, less reliance on things like points, which were sort of like incentives 2.0 recently. So those are the biggest changes I see. And I think you'll see that reflected in a lot of the protocols that are successful going forward.
What do you think the new mechanisms of incentives look like to grow those ecosystems?
I think you'll still have airdrops, and that's not going to go away. But post airdrop, I think that you see less token emissions than you would have in the prior DeFi era. And I think that maybe people still use points, maybe they don't. I'm not actually much of a points maxi. I think that was probably also a bit of a fad. And so the emphasis is going to be on finding projects early and early participation to get rewarded as a community member or somebody who's providing early liquidity. But there's also going to be a pretty big component of, can I source institutional capital or like capital from a hedge fund in order to seed my protocol and get the liquidity going, rather than having to bootstrap it all from retail, because the incentives are going to be lower and you need something that's a bit stickier.
I think the communities have also shifted a little bit in terms of the communities around DeFi years ago versus the communities around DeFi today. I mean, to some extent, you know, and I talk to a lot of founders who are constantly trying to break out of the echo chamber of crypto and bring more people in. And I think you're seeing more of that. Through some of it, we have a long, you know, through some lenses, we still have a long ways to go. I also talk to a lot of people where it feels like we're having the same conversation that we had 5 years ago when it comes to education and why this and how these different economic models can change. Colton, do you have any thoughts on how like the community composition, I guess, has changed now versus back then?
I actually maybe have a hot take on this. I don't think it's changed that much. And the reason why I feel like it hasn't changed that much is because one of the things that we've largely failed to do is bring in a ton of new users. And so what you have now are like, I would agree that it's a different profile because a lot of the retail users that were trying to get rich quick got washed out. But I think there's actually a lot of hardened crypto veterans that still comprise like, the bulk of those early communities that work with these protocols. And I think that the new money that's coming in, a lot of it's going to be retail that's maybe not like crypto native, and maybe they're not interacting with these protocols directly through like a MetaMask. And I think that my thesis is the next big wave of capital that actually goes into DeFi is going to be facilitated by things like Coinbase making those offerings available just through their application, or other centralized exchanges making it possible to one click into DeFi, and you'll get a bunch of nice wrappers with better UX around them that allow you to pass the yields through. And so you, like maybe that does kind of jive with what you were saying, is you'll see a new wave of people coming in that way, but they might not be, you know, typing GM in the Discord every day, like the previous generation of crypto natives.
I don't disagree with that either. Can we shift out of DeFi and talk a little bit more about broader trends at Arrington Capital? We've made some interesting investments recently that aren't all entirely DeFi, and we're also seeing more and more across Web2 or DePIN or other areas. Colton, you want to talk about sort of the hot trends that you're seeing on all the calls you're on?
Yeah. So I probably talk with now like 5 to 10 different RWA tokenization platforms a week. There seems to be a new one spun up every day. That's definitely a hot trend. And I think that's very predictable because the regulatory environment has changed dramatically. And now people see this opportunity to raise capital from crypto sources, international sources, places where it was previously really hard to access capital to build real physical projects in the United States. I think that the main problem that a lot of those projects are seeing is you end up with this adverse selection of the assets that are getting tokenized right now. The first wave of them aren't necessarily the best ones that are going to be the best returning. And so it's going to be harder to raise capital for them. I do think that we will see another wave of institutional offerings that are like legitimate private equity funds, legitimate credit funds that are brought on chain that will have really solid return profiles, and they'll be able to bring in a lot of capital on chain. I know I have friends who are working at like multi-billion-dollar like brand name traditional PE firms from college who are now calling me up asking me like, how do we tokenize our funds?
What do you
They're
think?
gonna be,
Why do you think? What do you think they're incentivized by doing that? Is
because
it like
they think they can raise more money doing it.
Okay.
Yeah. Yeah. I mean, that's always the answer, right? Is they think that they can raise more money and they can charge more advantageous fees. Because if you can increase the demand for a limited product, then the price for that product goes up. And previously, I think that a lot of these funds, there's like a limited market within the US, and then there are some sovereign and international funds that they're raising from. But there's definitely a lot of capital around the world that is comprises of smaller checks that wouldn't be worth sending your investment relations team out to talk to. But they might still, if you add all of those people up, they would still invest, and you can raise a meaningful amount of capital doing that. So I think it really democratizes access to a lot of these interesting fund offerings. So there's definitely a lot of opportunity in the real world asset space. We do have some investments that we think are targeting those institutional offerings. Like a great example of that would be Superstate. And they're one of the companies that I send a lot of these people to in order to tokenize those funds. So that's one area of investment. Another area is obviously AI. Everybody's talking about it. There are a few different places in which you can invest in the AI and crypto intersection. I think the only place so far that's received real product market fit is the decentralized compute space. We're seeing from our investments that we've made in this space that demand far outstrips supply. So there's plenty of demand for compute, and the real challenge is trying to find like anybody who has a GPU to lend to the network. It seems that these people don't care if it takes a little bit longer than using a centralized data farm. The cost savings are pretty incredible. And this goes for both GPU and CPU compute. There's a lot of demand for both of those kinds of DPINs. And I do think that falls under the larger umbrella of AI because that's where all the demand is coming from. Then there's actually the AI specific platforms like the agents and the verifiable inference. And I think that a lot of those solutions to some extent are still looking for a problem. We think that there's a lot of opportunity there, but it's a little less proven out what those use cases are going to be. Because the main thing that people are trying to use AI agents for currently is things like managing your portfolio autonomously or running a Twitter bot. And those are the things that have actually seen commercial success in crypto so far. I think that the problem with having AI run your portfolio, though, is that if you get a really good one, you're not going to want to make it public. And any edge that you created by having that AI agent is pretty quickly going to get competed out or evaporate. So you're basically left with these AI agents that are doing pretty basic tasks like rebalancing, yield optimization, which at that point, I don't even know if I call it necessarily AI. It's more machine learning, and you're using much more basic models to do that. So we're actively looking at the AI space. We've made some investments. We think there's opportunity there, but we're being very cautious not to get sucked into a lot of the hype, because I think just because something is AI and crypto related doesn't mean the token is going to exist in 4 years.
On a weekly basis, are we seeing more RWA pitches or more AI agent pitches?
Recently, it's been more RWAs, interestingly.
Most unique thing being tokenized right now that you've seen?
Let's see. Well, there's the recent uranium deal was interesting. We've seen solar farms being tokenized, which I also thought was pretty interesting. And a lot of it centers around energy, actually, now that I'm talking out loud and thinking about it. Various kinds of renewables or nuclear energy projects.
Even energy marketplaces, yeah. There's some
and energy marketplaces, yeah. The perps to trade it for trading oil, natural gas, you name it, electricity. So yeah.
I'll pause for, again, I want to keep this open and fluid. So Alan, Lou, Lily, anybody feel free to jump in with questions. Otherwise, we're happy to just sort of keep rattling. Yeah, Tim, go ahead.
Hey, Keli, Colton, good to see you guys. Colton, a question for you. If you were building now in the DeFi space, what would you be focused on? What are the killer opportunities that you see that won't have a ton of copycat Me Too's, where you can build a moat and really build a good franchise?
That's a really good question. I think the most common answer you'd probably get right now is stablecoins. I actually think that's probably wrong because there's so many large incumbents and the space is so crowded. I think you probably want to carve out a niche in like financial primitives for something that isn't very well, like you want to look for something that has a broken market structure, probably in traditional finance, that you can bring on chain and fix, which is why I thought the uranium deal was interesting. And for something like I would think in like the electricity or power trading space, there's still a lot of opportunity and really inefficient markets that could probably benefit from a lot of transparency and democratized asset access. So I would think about if there was a way to bring some of those markets on chain into a DeFi format. And I'd have to do a bit more research to fully flesh that out. But that's where my gut tells me that there's the most opportunity. I wouldn't necessarily want to compete to be the next like lending protocol or perps protocol, because there's so many of them now. And I think there's a consolidation that's taking place. Similar thing with, I think, the Athena style stablecoins. At this point, there's a few of them, and we're invested in one of them, which we think has a really solid risk model and is well positioned to compete. I don't know if you're going to benefit from building another copycat of that either. So I think you want to find something where you can be sort of the only game in town. And ideally, you're touching something where it exists in the real world, but the market structure is really broken and fractured, and it benefits from all of the things that blockchain brings it.
And then one follow-up from the fund perspective. So you mentioned you're seeing a lot of RWA meets DeFi deals. What are your criteria for selecting the projects that you think are worthy of investing in? What are the ones that you're most excited about? What do you like to see before you cut a check to them?
Well, the most important thing is the founders and that their background makes sense for what they're doing. So that's the first thing that we look at. The second thing that we look at, if it's an RWA deal, we look at, is the product highly commoditized? And if it can be highly commoditized, we want to invest in somebody who's like first or second mover. Like we don't want somebody who is pursuing something that already has a well-entrenched competitor that's kind of tokenizing the same thing, because that's going to be really hard to upset them. I'm not saying it's possible, but your odds are just really low. And ideally, like I said earlier, you're addressing something where there isn't really an efficient market in TradFi lands to compare it to. I don't necessarily think that funds are just going to trade on chain because it's on chain. Like most hedge funds don't care about the decentralization aspect. What they do care about is faster settlement. They care about transparency, and being able to execute in a manner where they're not worried about like counterparty risk that they might otherwise face. And so that's why I think a lot of these like energy opportunities are really interesting, because those are less efficient markets. Sometimes they're even sort of subdivided by geography. And I think blockchain could contribute a lot to those. On the like more institutional RWA side, I think that is even more of a like, are the founders the right founders to be doing this? And we've seen so far for the companies that have worked out in doing these kinds of like large tokenizations and working with large institutions, you have to be able to like sell to a large bank or a large fund. And you need a certain kind of profile in order to do that.
I think there's also something to be said for agility in this market of the team and being able to like really be focused on go to market. I think the early stage nature of Arrington Capital is very technical, right? We'll still do some infrastructure. We'll still do some more complicated cryptography-based, technically based founders. And as long as they're open-minded enough on the go-to-market side, that matters versus something that's super brilliant and great, but requires execution.
Okay, great. And one more follow-up. And John, I don't want to monopolize this. So after this, I promise I'll stop asking questions. Now, if we're talking about the RWA space, once again, you mentioned that you think there'll be one or two leaders in each category. If I think about that space and ingredients that will make for a successful platform, I see three things really. You need one, access to the assets. Two, you need distribution. And three, you need the experience to be able to structure products to marry the two. And typically the investment banks are the ones that have all three of those things. So you probably want to look for groups that can deliver on all three of those areas. Now, if you think that only one or two in a particular category will win, it means that you think probably, and this is what I'd like to clarify, that you think that they have a lock or a leg up globally on any one of those three things, probably distribution or access to assets being the most important, because the knowledge you can hire in. So if you're talking about solar, if you're talking about precious metals, whatever type of commodity or financial product, there's so much out there that it's really difficult to say that any one group out there has a lock on those assets. Unless you're talking about very huge asset managers, which they're not making these types of moves now. And then on the distribution front too, it's a very big world. So if you're talking about just tapping into Web3 capital, okay, there's a limited amount of capital there and mind share that you can carve out. So maybe you can make the argument that, yeah, the first one or two are the ones that are going to capture that. But there's a lot of capital outside. So how do you reconcile this?
Well, I think that in the case of like your commodities example that you're giving, if I understand correctly, you're basically arguing against my my claim that there's going to be a couple winners maybe for each of these, or like a couple winners writ large for commodities markets on chain. And I would argue that what you'll see is a pretty significant advantage to depth of liquidity once you have some of these markets get spun up and you have some winners emerge. If you want to, like, let's say you want to trade copper and you're going to do it on chain, and there's multiple venues for you to choose from. The biggest factors in what you choose is going to be, number one, can I trust this exchange? And that trust is largely going to be determined by like who are the backers and who founded it and what's their reputation in the space. And then the second thing, after you've answered the question of, am I going to lose all my money here, is it actually liquid enough for me to do what I want to do? And am I going to get efficient execution? And am I going to get all the things that I want? And once you have somebody who's in a position of having more liquidity than everybody else, it's really hard to break that, because all of the market makers are going to want to go where the volume is, and people are going to sort of coalesce around the largest players. So I think you sort of have this like virtuous cycle once somebody has established a foothold in one of these that's really hard to break. Like there's definitely a network effect, a benefit to an economy of scale in any of these like liquid financial markets where you have some place where all of the trading is happening. If you're referring to like the tokenization aspect, where like maybe there's multiple people who are able to tokenize copper, the problem you're going to have is unless there's some sort of fungible standard that comes out that allows for liquidity to be shared across these tokenizations, you kind of run into the same problem, because the tokenization is really only as useful as like a tokenization only becomes useful once it's easily able to be traded or used as collateral in different places. And the tokenizations that have the most liquidity to them and the most NAV behind the offering are going to be the ones that are listed first for different kinds of collateral or trading pairs. And once you have those, exchanges are probably, I would imagine, going to be reticent to list 10 different versions of tokenized copper. They're going to choose like the one or two that are the best, that they think they can get the most business off of. And so I think that you'll see the same kind of consolidation that you would see in both traditional markets and existing crypto native markets, where like, sure, anybody can wrap Bitcoin, and there are probably better options out there to wrap Bitcoin than the ones that have presented themselves. But the reason why Coinbase Bitcoin has been growing so much and BitGo's wrapped Bitcoin has been dominant for a while is because that's just what everybody was using. And so I think that there is really a strong benefit to that first mover advantage, because like I think that wrapped Bitcoin example is pretty close to what will end up playing out in the commodities market. That's not to say that you can't be an upstart and succeed. And there have been some attempts that have gotten some traction, like in the wrapped Bitcoin market, but it's really hard. And there's been a lot more that have failed. So that's my general thought, is it's really just a question of economy of scale once you get going, and the network effects that you get from all of that liquidity coalescing around your asset.
I think that makes sense with the more liquid instruments, especially once you go down the long tail and you start dealing with assets where there isn't a very deep market, and
Yes,
these assets are regionalized or very esoteric, then I think it's a different type of dynamic. But I agree with you when it comes to
I could totally agree with you on the tail assets. Yeah.
Okay,
Thanks, guys.
move on to John.
John,
Sorry, I took slow on the unmute button. But yeah, no, thanks for sharing all these ideas. It's really interesting. Question about personal credit. Have you seen any shots on goal there? Like, what do you think needs to happen for that to become more of a thing? Yeah, just maybe thoughts on that in terms of tokenization.
Yeah, that's an interesting one. Are you asking more about personal credit? Like if I wanted to get credit for myself, going and getting that on chain rather than through a bank? Or are you asking about like
Yeah.
securitizing the credit and then offering it as an investment after it's been issued?
Well, yeah, I guess those are the two sides of the coin. But I think, just I guess the basically replacing retail banking by opening up, lending to a wider pool, being able to kind of, I guess, federate and distribute loans using blockchain. And then obviously there needs to be some kind of collateral, or I guess my thinking is there's a lot of complexities around how to underwrite, but my thought was always that it was around just being able to keep track of, like, in some way, of who's borrowing. But I guess just broadly, is kind of, what are your thoughts there, and have you seen any protocols that seem to be approaching this in an interesting way?
The short answer is no, I haven't. I think it's really hard, and there are a few reasons why. I'll sort of partition this into, there's like secured lending and unsecured lending. I think there's already plenty of protocols that do secured lending pretty well. And those would be like the Morphos and the Aves of the world. And then I think the P2P lending market really never took off on chain because you could never get enough liquidity for it to actually be meaningful. The unsecured lending is probably what you're asking about, which is because nobody who's taking out a loan necessarily wants to lock up a ton of capital earning a low interest rate, because there's a huge opportunity cost for that. And presumably the reason why you're borrowing is either you don't have money and so you need money now, or you're trying to get like go use that money to do something that you think is going to be lower than your overall like return of the rest of your portfolio. And so I think the secured lending for both of those profiles doesn't make a whole lot of sense, unless it's really for just like taking a directional position on like shorting ETH, for example. And so I think if you're looking at the unsecured lending space, crypto doesn't actually offer that much, because the recourse that you have to an unsecured loan is legal recourse. Like you can go and take somebody's assets in bankruptcy, or more realistically, it's just going to damage their credit score, so they have an incentive to pay you back so they don't have trouble obtaining credit in the future. And so I think, like, given that those are the kinds of people who are going to be borrowing from you, you have to do it with some kind of centralized component where you're underwriting it based on a credit score or debt to income or something where you know personal information about that individual. And then you have to be able to service that loan with like debt collectors and a centralized apparatus where like a smart contract is just not going to cut it. And I've seen people try and attempt the equivalent of this on chain with a reputation score, but I still think that those are really going to be challenged, because you could it creates a really bad set of incentives where you could build up your reputation so you get to take out a lot of credit. If it's only tethered to your wallet address, eventually everybody's just going to walk away and like not repay once their credit line gets big enough. And if it is tied somehow to their real world credit, then maybe that would work. But at that point, why are you putting it on chain? And so I think that the more interesting thing here is to securitize and issue the asset on chain as an investment. But in terms of distributing this, you're going to need to use a centralized process to do the underwriting. You need to use a centralized process to do the enforcement. And then if you're making it like public on chain, what everybody's borrowing, I don't think anybody wants that. So there's not really much benefit to putting crypto in the loop there.
Well, so I guess maybe on the on unsecured side makes sense. But if we're talking about, I think the example of like tokenizing solar farms or DePIN assets or something like that, we're now, there's a secured, on the secured side, I think the examples or the concepts you provided are referring to like financial assets as security. So you're tying up one financial asset in exchange for another, I guess, right?
Mhm.
What about, bringing other, I guess the whole concept here, the thing we're looking to do is bring non-financial assets on chain. And I guess there are complexities around like the legal process and how to take ownership and whatnot. But, real estate is an example. Like I think, everybody's thinking about this, but it's one where you have this, let's just say I own a house. I want to take out some cash. I have equity in the house. I want to take out some cash. Banks won't allow you to do that generally, right? Or I guess this kind of only works in a scenario where the house is completely, there's no loan whatsoever potentially, but there's probably a way to structure it too, so you can take cash out from that asset by putting title into, in some kind of a trust and putting it on chain. Maybe does that make sense to you?
Yeah, I mean, it makes sense what you're proposing, but I don't know why that needs to be on chain
Yeah.
because you can
Okay.
already get a HELOC from a bank.
Mhm.
And they're like, they are underwriting that.
You have to do the same things to execute it on chain. Like Colton, to your point, I think you'd have to still do all the things that you were talking about.
Mm.
Right. I just think like once you put it on chain, you're just adding extra steps that aren't necessary because the bank is already like set up to keep a record of it. There's existing processes in place to manage the title. What maybe they could distribute the loan to you in USDC. And I could see that happening, where you receive the loan in crypto and then you can go and use it however you like. But I think that the actual origination and issuance, there's not much need to be adding blockchain complexity to the existing process. I'm not an expert on how like mortgage originations work, so maybe I could be corrected here, but it seems that you have a pretty entrenched system. All the business in town is being done by banks that don't really have much incentive to change, and they're not gaining a material benefit by putting that process on chain. So I don't see why they would.
Mm-hmm. Okay. Yeah. Cool.
Okay.
Thank you.
I'll jump in here with a question. If we go back to the comments you had on AI and portfolio management, could you describe that a little bit? Are you talking about just using an agent to see what funds you
Yeah.
have, what balances, things like that? Or are you actually talking about trading agents, whether it's crypto or stocks?
Yeah. So there's this meta recently about AI or DeFi AI. It's been very hot amongst a lot of VCs, and there have been a ton of companies that have been popping up that put themselves into this category. And the general idea is, well, now AI is so good, like, why am I trading? I should just have the AI trade for me. And maybe I could tell the AI, hey, I want you to do X, Y, and Z for me. Maybe it's like, it could involve something that is like limit order based, or maybe I have a set of signals I want the AI to look for, and then they trade.
Strategy based.
Yeah, like strategy based, where the AI is coming up with some strategy, or it's watching your portfolio 24/7 to basically do a better job than you would be able to do yourself. And I think that a lot of the people who are really excited about this probably don't have much experience actually trying to build trading models,
Mhm.
be- because I just don't see any way that it works. Like the signal to noise ratio is so low in finance and in financial markets in general that anytime you try to apply a really complicated AI model to a like broad financial markets problem, you run a really high risk of overfitting. And when you do find an alpha, it's usually because you had some sophisticated insight that allowed you to structure the way in which you built that strategy. And that alpha is going to decay materially over the next year. And I just, yeah, I have a very hard time believing that AI is going to be useful for much more than like, okay, Aave's yield is now lower than Compound's yield, so I'm going to rotate you from one into the other. Like that, it could be very good at because it can watch it 24/7 and it can adjust your portfolio on the edges. So stuff like that, I think it's fine for. I don't think you need an LLM for it. I certainly don't think you need an LLM to do like trading for you.
Yeah, well, it wouldn't be an LLM. It would be, using reinforcement learning
Yeah,
and more game theory, going back and going through years of trades and activity and looking for patterns and then potentially applying those based on different strategies. Are you
right.
seeing any of that or?
Yeah, there are people who are like trying to do it. I just don't think it's going to work very well. Um,
Okay.
is my opinion on it. I think that uh, I think maybe if you provide somebody with a framework where they can build this for themselves and you have enough sophisticated users who are able to build that for themselves, I could see that maybe working. But a majority of people who try it are probably going to lose money. And so the long-term viability of that business, I think is going to be challenging because there are so few strategies like that which will actually work out that you don't want to end up, churning most of the customers to that framework after a couple of years, right?
Right. I mean, you assume the big trading houses have algorithms and AI already doing this stuff. It would be more for, individual traders and those type of opportunities who do know what they're doing and, would like to try their methodology and their strategies to actually do their trading and manage their portfolios.
Yeah.
Yeah, I mean, I'm just jumping in here, guys. I tend to agree with Alan. There's this company, I forgot the name, it's like Platinum something, but they've been doing like basically machine learning trading for several years successfully. And they're getting bigger and bigger. I I do see AI becoming better at trading than most people. Probably not everyone, but that day is already here. It'd be interesting how you apply it to like
Yeah.
on-chain transactions.
Albert, if you remember that name, you could post
Yeah,
it
actually,
or
let
let me
me.
know.
It's actually one of my friend's portfolio companies. So I'll just text them, and I'll
Okay.
I'll get that info from you or for you. Right.
I'd be curious, is that like a firm that's doing it themselves, or are they like offering this strategy to like anybody who wants to invest?
To individuals now, yeah, to individuals now, but they also have institutional clients. But yeah, their vision is to make everyone like a stock trading pro with this. Yeah.
Yeah. I think like my general concern with these kinds of things is it might work really well in the short term if they have found something good. But if once they start giving it to too many people, then like the strategy is going to get crowded. Um, and I know for a fact, like there are a bunch of strategies that are being run at Citadel right now that have, $50 million like limits to how much you can put through the strategy. And once another quant shop figures that out, like that alpha is going to decay because they're going to crowd the strategy. And then, you're only going to be able to do 25 because they're doing 25 into the strategy. And so the returns do like diminish for these kinds of things over time. And as the AI gets better, ironically, like these strategies perform less well because then more people start crowding the trade. And so it's sort of like it is it's everybody's trying to front run each other and it sort of ends up becoming a race to the bottom once it becomes really good that it becomes widespread.
It may turn out that way, but there's always like arbitrage opportunities, right? It's never like a smooth line. Um, that comes out Platinum Analytics. I'm just typing it here.
Thanks, Albert.
Yeah, thank you.
No problem.
Okay.
But,
Thanks, guys.
yeah, it'll be interesting, right? There'll be more and more sophisticated AI bots or agents or whatever, right? And they're gonna eat up the arbitrage opportunities. but then by plugging one hole in the market, there's going to create another opportunity somewhere else. It's like, all right, the market is always changing, so it'll be very interesting, right, to see how it plays out.
Yeah.
Alan, I know we're kind of down to the last few minutes here. I was thinking the other helpful thing, just knowing this group, is that it might be good to talk about the current fundraising environment and
Definitely.
is you good with that? Yeah. So maybe Colton, I know that again, we look at a lot of different deals. We prefer earlier stage over later stage. We like doing follow-ons. We're founders first, and we like supporting founders for the longer term. But right now it's a little bit different out there. And Colton, maybe you can talk about sort of what companies need to have from an MVP to like an early stage or any sort of traction or revenue to sort of raise a seed or a pre-seed versus like a Series A.
Well, for pre-seed, I think you don't really need anything. You just need a compelling founder with a large vision. And I think every VC is looking for something that's a highly asymmetric bet. And so the most important things are that we believe that you can build what you say you're going to build, that you're in it for the long haul, and you're attacking a big market with a really high TAM.
Yeah, but how
And
hard is it for those groups to raise right now, like over the past?
yeah, and so I actually think it's probably valuations are in general coming down because they're following public markets. I think typically there's a lag, so there's still some funds that are deploying, and it's still possible to raise money. I actually think it's easier for the earliest stage companies to get funded because the time horizon for that investment is well beyond any of this like short-term turbulence that we're experiencing. I think the hardest rounds to raise right now are going to be those pre-TGE rounds, like Series A's, strategic rounds, and follow-on investments, because a lot of investors see that token timeline falling within this area of uncertainty where they want to apply a big discount. And so I think those are the raises where it's really challenging. And if you don't have to raise, you probably don't want to be. If you're like later stage about to launch a token, there are obviously going to be exceptions to every rule. And we're seeing companies that do have really successful fundraisers. But the way that you have a really successful fundraise right now in the later stages is you have to have strong metrics. And I think investors are placing a higher than usual value on things like cash flow, the ability to do token buybacks, and strong fundamentals, because the market seems to really be respecting those tokens versus other tokens that it views as being more meme and hype driven. That could totally change within the next few months if we see a big reversal in macro conditions. But right now, the market is putting a higher premium on companies that can be profitable or throw off cash. And it's harder to raise later stage rounds relative to earlier ones.
Yep. Super helpful. Great. Appreciate the questions on this session from the group. Always, Crypto Mondays crowd always brings the smart thoughts.
Yeah, that's good. I don't see any more questions here. I don't know if you guys have any final thoughts.
You know, we've seen like a massive pullback for pre-seed investment, at least in the Bitcoin like startup space. Like barring like the other time that it was this tough was crypto winter, but that was tougher than now. But we are seeing like people that are normally not investing in Bitcoin space coming into Bitcoin space because, to your point, valuations are dropping. And I think smart investors are they see that arbitrage opportunity. And a lot of the like the first wave of I would call like the Bitcoin Renaissance investors, they're out of dry powder, right? They're looking for the TGE in the market to come back so they could recoup some of that capital, redeploy it. Yeah.
So we have a couple more minutes. I do have one question. I put a bunch of comments in the chat, but the question, it's more about fundraising for funds and what the situation with funds is in general right now. I mean, I'm getting pitched limitless at this point to invest in funds. And between us investors, when we see the updates, there's a lot of difference in valuations of the same company in different portfolios. So the gut feeling we as to on the investor side have is that most VCs are deeply underwater, and the question is just how transparent are they, because they're trying to raise their next fund, to show us, in quotation mark, how bad the situation actually is.
I think a lot of VCs are underwater. We've been very fortunate, and we had some launches go really well over the past year, and a couple recently that have been nice markups for us. But I don't think everybody's really in that position. I was talking with some other funds at an event in person last Friday who were basically like, yeah, we had this multi-$100 million fund, which we round tripped, and that's the state of a lot of things. I mean, like VCs are heavy on altcoins. Like that's pretty much all you're invested in if you're running a pure VC fund. And altcoins are down to all-time lows for many of them. And it's been a tough environment.
Mark, I think there's also an element of what's the funds focused. Are they only doing Bitcoin things? Are they only doing alt things? Can they do all the things, right? I think with the speed that the industry is moving, like what the mandate of these funds is becomes more and more important too.
Yeah, I think it's like very, like what Keli was saying, very advantageous that we are set up in like the flexible way that we are. I think the funds that are really going to have the toughest time are ones that were forced to deploy too much into subpar opportunities, and that don't have the flexibility to be participating in really attractive liquid opportunities.
Well, thank you for the insight. And yes, I think the private conversation between VCs, I think those are the interesting conversations right now as well. Yes, thank you for sharing.
I got a follow. Well, it's not a follow. This is a different question. It's like the Ethereum versus Bitcoin price. How come? The background is that in crypto winter, let's say we take the lowest point, which is roughly second half of 2022, and Ethereum was like right over 1,000, and Bitcoin went down to 16,000. So it was, I don't know, 6-7% of Bitcoin ish, and now Ethereum is only like 1 point something percent of one Bitcoin. Like why the divergence? Like from the bottom, Ethereum has only gone up like 45% versus Bitcoin has gone up like 5x, right? It's like, how come that's happening? And
Well,
what's happening with Ethereum?
I think what is notable is how strong Bitcoin has been. In particular, I think a lot of that's attributable to a lot of institutional capital that's flowing into Bitcoin. The ETFs have been successful. If you're an asset manager, you're putting your client into Bitcoin. And I think that's provided a huge bid. And there's also Michael Saylor. He bought a ton of Bitcoin over the past year, and that certainly had an impact. And so I think that Bitcoin's strength is something that is really the biggest story here. I mean, ETH has done poorly, and you can come up with a lot of reasons for why that's the case. It could be that it's inflationary again, bad retail sentiment, that L2s are sucking all of the apps off of L1, that the foundation hasn't built fast enough. And maybe it's a combination of multiple things, but I think the Ethereum Foundation is working hard. They understand the challenge that's ahead of them, and they're working to improve things. We're seeing a lot of really interesting projects still being launched as L2s and on ETH. So yeah, I think it's been largely sentiment driven. But that doesn't mean that Ethereum projects are no good. We still see a lot of really good opportunities there.
Oh, very
If it wasn't
interesting.
ETH, what else would it be? I mean, another chain besides Bitcoin? seeing Solano or?
Yeah, I think Solano's done really well. I mean, I'm going to be like biased here, but like we've also got a lot of other strong L1s in the portfolio. There's a lot of cool stuff that's happening on Sui. We have other like smaller L1s that are like purpose built for different applications that I think are really interesting. And yeah, I think there's still an opportunity for an ETH comeback. I'm not saying that it will do as well as Bitcoin over the past year, over the next year. Like it definitely has some recovery to do, but we'll see.
Okay, great. Thank you very much. Thank you, Colton. Thank you, Keli. Great session. Every time you're on, we end up learning all sorts of things. Great insights into the market and what you guys are doing. Thank you so much for coming and joining us.
Thanks, Alan and team, for coming. Thank you.
Thank
Thank
you.
Thank you, everyone.
I always stay in touch.
Oh yeah, you have some contact information
Yeah,
can
you
put
guys
in
can hit
chat.
me up on Telegram or Twitter, whatever works.
Okay. Do you have a channel, or do you I don't know if you can put anything, or we can get it out. Just
Here, I'll
anybody can always email info@cryptomondays.io with a question too.
my Twitter is Colton F. Conley. I put it in the chat. Feel free to DM me there.
Wonderful.
Okay. Great. Thanks again. Have a good one.
Bye.
Here, everybody.
Alan.
Whoops. Okay.
Alan.
Yeah. Go ahead.
Yeah, I made a mistake. So over the years, Platinum Analytics, it looks like they're just focusing on institution now.
Okay. So there's nobody really in the retail space that's big.
Yeah,
Just
they
know
had
of.
started in the very beginning, in their Series A, I remember seeing that they did have that, you know, like a retail component.
Mhm.
But it looks like, but this was I want to say 4 or 5 years ago. So
Okay.
it looks like they're just focusing on institution now.
Yeah.
Uh,
Yeah.
but I do think the market is definitely ripe for retail.
Yeah. I'm thinking the same thing. I'm helping out on a project we're doing training on stock trades to create some new AI models and AI agents that you can apply different strategies to. So it'd be interesting to see what else is out there. That's kind of why I was looking.
Nice. Yeah, I mean uh it's gonna become a very interesting world very soon.
Yep. I mean, it might end up just a bunch of bots doing everything for us. It's
Yeah, well, I mean, maybe like in the long run, but in the next few years, like I definitely
lots
not.
of opportunity. Yeah.
Yeah, but it'll become like a mixture, right?
Yeah.
Until one day AI is really powerful, and then like you said, it might just be them trading for us, or maybe
Right. It kind of comes down to what's the point? It just each agents fighting each other, getting the opportunities, finding the difference, and as Colton said, it ends up decaying. So you go on to the next thing, probe for it, find it, take advantage of it, and move on. It'll be
I mean,
interesting.
well, yeah, no doubt it'll be very lucrative in the beginning, and then
Mhm.
I mean it's like but that's with every market though. It's like with the restaurants. If you just have one in the city, then it'd be super profitable, and people keep on opening them until it reaches the equilibrium. But can you not have restaurants? Probably not. Just like in the future, can you